finally, there's something I call the taxi driver index, and people talk about this in bull markets, and when a market is going gangbusters, and look just back recently to the internet boom, as things were going gangbusters, you'd hop into a taxi cab and you hear the taxi cab talk about the investments and the shares that he was owning. Now, for me, that is a warning signal to get out of the market. Similarly, looking at that taxi driver index, it's getting a pulse on what's happening with the market. There's so much bloodshed at the moment. There's so much, people are just losing money, and they're so fearful at the moment. Everybody's so scared. I think if you look in your newspapers, you look in your magazines, you look on TV, you listen to the radio, everybody's just so pessimistic. That's a fantastic sign that the bottom is not far off. You really do just have to look back in history and see, things repeat themselves. This is nothing new. These signals have in the past signified the bottom and been not far off. That said, I don't necessarily want to try and pick that bottom, but I know I'm going to be eagerly watching, because I've been sitting on the sidelines waiting for this opportunity to move back into the market and find some of those fantastic opportunities. So now, for the moment you've all been waiting for, I suppose you're wondering where I'm looking to invest. Now, as I said, I'm cashed up and ready to take advantage of some of these opportunities. And where am I actually looking? Now, I'm probably going to steer clear of looking at the US, Europe, and I throw Australia in there. I know we're only a very small part of the global economy, but that's where I'm based. But I am going to look to steer clear of those markets. I feel like there is going to be a slow recovery. It's definitely not going to happen overnight. The US is effectively in recession. I think it's only going to get worse, especially when you consider some of these honeymoon rates that I was talking about for those low doc mortgages. A lot of those are coming up to their expiration period, where the honeymoon period ends and the mortgages jump. So I think there is going to be a lot more trouble on the horizon before it gets better. That's not to say that there aren't going to be some good opportunities, and I did mention with some of those things that I'm looking at, those indexes, to keep a gauge on what's happening. I don't think it's that far off, but I don't think we've seen the worst of it yet. I'm going to steer clear of the US, Europe, and Australia. Another reason being, for demographically speaking, you've got the baby boomers who are the biggest sort of population spurt that we've seen in many years. They're coming to the end of their spending cycle, and they've spent up a lot of their retirement, doing the things that they wanted to do. Like I said, buying those bigger houses, going on the holidays, getting the bigger cars. They're coming to the end of their spending cycle, and I think with that happening, it's going to put more pressure on the economy, because obviously spending is what really does drive an economy. And as that begins to dry up, coupled with the fact that there is so much debt, and I think there's more to come, I think there is going to be a slow recovery. It's not going to be overnight, and it could take many, many years. That said, though, I do read quite a lot, and one of the guys I keep an eye on is Andre DeBosi, and he does a lot of demographic studies, and is a big follower of Harry S. Dent and his demographic studies. And I was reading some of his reports recently, and I've got one of them here, and he was talking about how some good companies are getting caught up in what's going on, in this global sense. Good companies getting caught up in this financial crisis, and the valuations aren't necessarily reflective of what a company's worth. And I think I wanted to give you this example. It talks about a pulp mill in India, and a perfect example of good companies getting caught up is this Indian company purchased a pulp mill from a Canadian firm, took it apart, shipped it over, and rebuilt it in India. The pulp mill produces 125,000 tons of paper each year, which equates to $11 million profit. But here's where it gets interesting. To build the pulp mill would cost over $200 million, but you can buy the company on the Indian Stock Exchange for $35 million. As you can see, feelings don't necessarily match the facts. And emerging economies, especially because they are far from home, people, as a knee-jerk reaction, tend to pull their money out of those markets first, because they are one of the first to feel it when there is a bit of a shake-up. That said, they are also one of the first to rebound. And I think emerging markets have been hit incredibly hard as those investors look for safety. However, you know, the value of the index is nowhere near a true representation on the underlying companies themselves. I just see so much opportunity there. We haven't seen emerging economies this cheap for the last 20 years. They're the cheapest they've been in 20 years. And by emerging economies, I'm talking about India, Russia, China. And as far as my pick is concerned, and I've put it on the picture there for you, I think India is going to be the next powerhouse and represents fantastic investing opportunity. You know, China still has a lot of growth and still a lot of potential, but it really is reliant on a lot of exports to the US and the rest of the world. And as the US economy grinds to a halt, and Europe, I think a lot of those exports for China is going to dry up. But when you compare that against India, India is a lot more self-sufficient. They don't rely as much on exports as some of the other emerging economies. They really do consume a lot of what they create, and there's just a huge population there. As it starts to shift into, you know, they want better standard of living and higher quality to bring them into line with, you know, other first world countries. There's huge demand there just for the basics, for cars, for telecommunications, and that growth there really represents fantastic opportunity. I almost feel like the attention will start to shift as seeing the US as a superpower to some of these emerging economies, and I know that's my pick and that's where I'm going to be looking. Which brings me to my last slide for this little session. I think it's important to keep everything in perspective and keep everything, you know, as viewers, as part of the greater picture and what's really going on. And a big part of that was the way I entered into this presentation when I talked about the skies falling and how you don't believe everything that you hear. Coming back to full circle, just think in terms of the seasons, and I always almost like to think of the market as a good reflection of the way the seasons work. There is a summer, there is an autumn, there is a winter, and there is a spring. Now, when it comes to where we're at in the current financial crisis, we're in winter, and everything always looks bleakest in winter. Everything is darkest before it goes light, however. Spring is just around the corner. There is going to be some new opportunities to invest. And while everybody's pulling their hair out and crying because they've lost so much, shortly we're going to be in a situation where spring is here. And what should we do in spring? You want to make sure that you sow the seeds so that when summer comes, you can take full advantage of that summer sun. And that's what we need to be looking at doing. You need to look for those opportunities that are just around the corner. There's going to be plenty of opportunities, and you need to start to sow your seeds. So when summer turns and the economic growth springs back to life for summer, you're there to take advantage of that.